The credit card reset. How a temporary interest cap could help families, small businesses, and the economy. Why this matters. What if I told you that one small policy change could instantly put billions of dollars back into people's pockets, without raising taxes, without printing new money, and without creating another bailout? That's exactly why the proposal by Donald Trump to temporarily cap credit card interest rates at 10% has sparked so much debate. Today, we are not here to argue politics. We are here to ask a simple question. If this policy actually happened, could it help households and the economy? Short answer, yes, and in more ways than most people realize. Let's break it down. The real problem. Credit card interest is a hidden tax. Right now, millions of households are trapped in a silent financial drain. Not because they are reckless, not because they are lazy, but because interest rates have exploded. Today, average credit card APRs sit above 20%, and in many cases, 25% to 30%. That means a $3,000 or $3,000 balance can double if carried long enough. Minimum payments barely touch the principal. Families stay stuck even while working full-time. This is not just a personal finance issue, it is a macroeconomic problem, because every pound or dollar paid in interest is money not spent in the real economy. What a 10% cap actually does. Let's be clear, this proposal is not debt forgiveness. It's not a bailout, it's not free money. It's simply a temporary limit on how expensive borrowing can be. A 10% cap would cut interest costs in half or more, allow repayments to reduce principal faster, give households breathing room, not handouts. This matters because cash flow is everything. Households don't fail because they owe money. They fail because they cannot catch up. Immediate benefit. Households get relief without new debt. The first positive effect is instant relief. Lower interest means lower monthly payments, faster debt reduction, less reliance on new borrowing. And this creates something incredibly powerful, psychological relief. When people see balances go down instead of sideways, behavior changes. They spend more responsibly, plan long-term, re-enter the economy with confidence. That confidence is economic fuel. Consumer spending becomes healthier. Critics often say, lower interest will just make people spend more irresponsibly, but history shows the opposite. When interest costs drop, spending becomes intentional, not desperate. Consumers shift from survival mode to planning mode. Purchases move from minimum payments to real goods and services. Instead of paying banks 25% APR, money flows into local shops, tradespeople, repairs, services, education. That is productive spending, not speculative spending. Small businesses win. Here's something rarely discussed. Millions of small businesses use personal or business credit cards to survive cash flow gaps. High interest rates crush them. A temporary cap would reduce financing costs, lower bankruptcy risk, keep small employers alive. And small businesses are not optional. They employ local workers, apprentices, families. Supporting them stabilizes communities from the ground up. Fewer defaults, not more. Banks warn that a cap would increase risk. But this ignores a key truth. High interest increases defaults. When interest becomes unpayable, people give up. Lower interest means higher repayment rates, lower charge-offs, fewer collections, fewer bankruptcies. In other words, banks get paid back more reliably, even if margins are slightly lower. Volume beats predatory pricing, reducing systemic financial stress. Right now, household debt is a pressure cooker. When people fall behind, stress rises, productivity drops, healthcare costs rise. Social systems get strained. A temporary cap acts like a pressure valve. It doesn't eliminate debt, it stabilizes it. That makes the entire financial system less fragile. Why? Temporary matters. This is crucial. A temporary cap avoids permanent market distortion, allows banks to adjust, acts as an emergency stabilizer. Think of it like a circuit breaker in markets. You don't use it every day. You use it when systems overheat. Right now, credit markets are overheating at the household level. Economic multiplier effect. Here's where things get powerful. Every dollar not paid in interest doesn't disappear. It gets spent, saved, invested. That creates a multiplier effect. Businesses earn more, workers earn more. Tax revenues stabilize without raising rates. This is stimulus without government spending. Why this helps the middle class most? The wealthy don't carry credit card balances. The poorest already struggle regardless of APR. But the middle class? They are the ones crushed by inflation, stagnant wages, rising interest. This policy targets the exact group that spends the most, works the most, pays the most taxes. Helping them helps everyone. What this does not do. Important clarification. Let's be honest. This policy does not cancel debt, remove personal responsibility, destroy banking, end capitalism. It simply says there should be a reasonable limit during extraordinary times. That's not radical, that's pragmatic. Historical context. Temporary caps have worked before. Throughout history, temporary controls have been used during wars, financial crises, inflation shocks. They are not permanent tools, they are stabilizers. Used carefully, they prevent collapse rather than cause it. Long-term cultural shift. If implemented, something subtle but important happens. People start to see debt as manageable, repayment as achievable, saving as possible again. That cultural shift matters more than any spreadsheet. Why this could strengthen capitalism? Healthy capitalism depends on trust, mobility, opportunity. When interest rates become extractive, capitalism weakens. A temporary cap restores balance, not anti-market, not anti-bank, pro-stability. Final thoughts. Why this idea resonates? This proposal resonates because people feel something is broken, not everything, but something fundamental. A temporary credit card interest cap says. We see the pressure, we acknowledge the strain, we are willing to pause and reset. And sometimes that pause is exactly what an economy needs. If this policy comes to pass, it won't solve every problem. But it could reduce financial stress, strengthen households, support small businesses, stabilize the economy. And in times like these, stability is growth. If you found this breakdown helpful, like, subscribe, and share, because economic literacy is power. And remember, a healthy economy starts at the household level. Stay aware, stay awake. This is Felix. See you next time.